Hi everyone, welcome back. So what we're going to do today is we're going to talk about compound interest, home loans, and why it takes so long to pay a loan off. And what the lenders do is they refer to loan amortization, and that's the method that they use to calculate what your loan repayment is going to be. So I'll draw a diagram quickly and I'll demonstrate this to you. Okay, so what we've got here is a $300,000 loan, and I'm going to use an interest rate of 5.8% just to demonstrate this to you. So at the moment, home loan rates are sort of somewhere around there, 5.6, 5.5, 5.9%. So we'll work with 5.8%. So if we take our home loan at 5.8% and we want to work out what is the loan repayment on a monthly basis over a 30-year period, and this is calculating the loan initially when you take it, and of course interest rates are going to fluctuate if you've got a variable rate loan. So the rate will go up and down over that 30-year period, and of course the lenders will have to adjust your payment accordingly in line with that rate adjustment. But initially when they work your payment out, this is what they do. So we have an interest component to your loan repayment, and we have a capital component as well. So if we have a look at the loan, if I draw a line like this, the amount of money that you're going to pay back to the bank, which is on the outside here, this is your capital. Okay, that component over there. And the debt that's sitting on this side of the curve, this is the interest that you're going to give to the lender. So that's why it's taking so long to pay this loan off, because you're going to give the lender so much interest. So in this scenario, it's going to take you 30 years to pay this loan off. And you're going to give back to the lender on average 2.3 times what you borrowed from them, once you've paid them back the interest and the capital. So the only way to get out of this situation is to put more money into it. But I'd like to just demonstrate to you how this works. So when you make your very first payment on this loan, the way the payments are calculated is we come over here and we make payment number 1. So there is our payment. Okay? So this is just to give you a visual on what's happening. This little component over here, that's the capital that you're paying on your loan. And this component over here is the interest that you will be paying on the loan. So you can see very clearly that you're going to give the lender a lot more interest and a tiny little piece of capital. Okay? So when we start out, if we look at our payment, 100% of our loan repayment would be $1,760.26. That's what our full 100% payment would be. But that's broken up into two components, interest and capital. So if I have a look at the capital component, that's a total of $211.23, and that is 12% of what I'm paying back to the lender. So just 12% goes to capital. The other 88% of what I'm paying is going to go on interest. Okay, and that's a total of $1,549.03. So that's how my first payment is made up. So you can see very clearly that it will take me a very long time to pay off the capital component of my loan because I'm giving the lender so much interest. And you're always paying a lot of interest initially, and then at the later stages in your loan, you'll start to pay off a whole lot of capital. So in this scenario over here, if we're making our payment every single month, there we are, making our payment all the way down here, we're slowly getting to a position where we go down this curve and we're paying more capital on our loan as we make our payment. In 15 years' time, we will get to a point, which is about here, where 50% of what we're paying is going to go to capital and 50% will go to interest. And at that point in time, you'll start to pay off the remainder of the debt quite quickly. But we want to get into this position a lot faster. And the only way to do that is to put additional money into your loan. Because your loan is set at a payment of $1,760.26, if you put $2,000 into that loan, the gap between the $2,000 and the $1,760 will come off the capital. it doesn't get applied to the interest component. And the more capital you pay, the less interest will need to be calculated, the more will go towards the capital. So I recommend to everybody, if you've got any spare money, instead of putting it into a savings account, stick it into your home loan. Just make sure that you have the ability to redraw off that loan and that you're not going to get penalized for putting the money into the loan. So thank you very much, and I'll see you again in a few weeks' time.